Hey folks, my name is Mansoor Sohail. I'm an accountant operating out of Scarborough, Ontario, and my specialization is tax for Canada and USA. My today's presentation is for educational purposes only. I will be talking about making projections from cash flows. Cash from line items consist of depreciation schedule, working capital schedule, or debt schedule. We must complete depreciation and working capital schedules first. Cash from operating activities. Cash from operating activities comes from net income. Select net income before any distributions for making your analysis. Then look for other operating activities. Difficult line items can be projected in following different ways. Conservative, that is minimum of the past 3 years. We assume money spent is more conservative than money received. Taking minimum amounts for the last 3 years may not be most accurate, but it is conservative approach. Aggressive, the maximum of the past 3 years. Assuming more money received is more aggressive. We take the maximum amount for last 3 years. Average. In this method, we take average of the last 3 years. Last year, recent approach. This is based on an assumption that company's performance last year is most indicative of its future performance. A combination of this method and conservative method is quite useful indicator. Repeat the cycle. In this method, a trend is followed. As an example, the easiest way to do this is to have the projected 2013 year to equal to the historical year 2010. This way, 2014 will be same as 2011 and 2015 will equal 2012 and so on. Year-over-year growth. In this method, we can assume year-over-year growth. Growth rate can be dependent on another line item. For example, we can assume that rent will increase 5% each year. Other line items can depend on another income statement or balance sheet items. For example, commission expense may be projected as percentage of gross sales. An analyst should always add details to his assumptions for clarity purposes. Cash from investing activities. Basically, management will provide guidance on capital expenditure. It is sometimes considered as percentage of sales. Proceeds from disposal of property and equipment. A recommendation is to take a look at quarterly report of corporation's activities and be conservative. Being very conservative can mean no more disposals. Items based on cash available. Investments such as purchasing securities are not necessary to drive the operations of a business. But if a company has a surplus of cash, it is wise to make such investments. A company can choose to buy back its shares as a way to increase value in its stock. These kind of items are almost unpredictable. It is recommended to listen to company's latest conference call to see if cash management or future cash initiatives are discussed. Cash Cash flow from financing activities. Raising or buying back equity. Raising or paying down debt. Distributions. Dividends equal shares outstanding times dollars per share. We can use project out as a percentage of an income statement or a balance sheet line item. Purchase of stock is a share buyback. When a company buys back its own shares, cash is spent and number of outstanding shares in the market reduces. The process of share buyback can be considered as an item based on cash available. A company will only buy back shares if it has excess cash. Effect of exchange rate. This is a volatile line item. Average or conservative methods can both work. Folks, source of this information is from the book Financial Modeling and Valuation, written by Paul Pignataro. Thank you.